Welcome back to Online Trading Summit. Jay Petit, our next presenter, is the founder of Charts Avenue, an education company that offers technical analysis training courses to financial institutions. In 2005, while studying for his CMT, Jay moved to UBS Wealth Management in Singapore and subsequently received the converted Chartered Market Technician designation in 2008. In his presentation, Jay shared how he adopts a discretionary trading approach using price action, confluence, and risk management. So let's head in and find out more about his trading approach. Hi Jay, welcome to the Online Trading Summit. How's the day going for you right now, man?
Hi Philip, good to see you. All good for now, thank you.
Okay, great. Thank you so much again for agreeing to come on board this Online Trading Summit. And I believe your topic you're going to be sharing with us today is about how to find good trading ideas using price action, confluence, and risk management. But of course, before we get you into the topic itself to do some presentation that you have prepared for us, I think it would be really helpful for us, for me and the summit participants, to understand a bit about your background. So would you mind spending a few minutes to share with us how do you actually get started in the financial markets and how has that career evolved for you over the years until today?
Sure. So I started actually in Switzerland, in Geneva, in the commodities and trade finance with a bank that was the Swiss Bank Corporation, which later on merged with UBS. I guess UBS is still well known now. I then moved to Zurich, Switzerland, to start in the equity business. And there I was invited from time to time to the prop desk to help out with the prop desk. So that got me really interested in trading the stock market. And while there, I was getting more and more focused with technical analysis because I was chatting with a lot of fundamental analysts, and they were very specific. You know, there was like either they are in the automobile sector or telecom sector and so on. And I saw that those that were looking at technical were actually more global, and they were able to look at over the world, every country, and then dive into the sectors and then dive into the industries. So I was saying, oh, that's pretty good compared to fundamental analysis, right? And that got me started to look at more and more in-depth technical analysis. And I saw that all the technical analysts had that CMT designation. So I was wondering, what is that CMT? So I dive into it and I saw, okay, it's a self-study, just like the CFA. So I went out and started studying that for the 3 levels. So in 2008, I finished and received my designation, and that got me even more into the technical analysis. In between 2005, I moved from Zurich to Singapore and continued in the equity side for UBS. And then more and more I was thinking of technical analysis. And so in 2016, I left UBS to start my own company. It's pretty focused on technical analysis.
I see. Wow, that has been a very wonderful journey that has got you through all the way until where you are doing today. So I think it's, I can't wait to hear what you have got to share with us in terms of the way you look at the market, in terms of the way that you look for a good trading ideas. So Jay, I'm going to hand over the stage over to you right now. So please go ahead and share with us what you've prepared for the summit participants.
Sure. Thank you so much. All right. Just a quick disclaimer, right, of what we're talking today. So the first question is obviously, what is technical analysis? So technical analysis is a study of market action primarily through the use of charts for the purpose of forecasting future price trends. So that was said by John J. Murphy in a book called Technical Analysis for the Financial Markets. So this is one of the first books I read during my study of technical analysis. It is a fantastic book. I can recommend to anyone interested in technical analysis to read it. And to summarize the book, it basically says that markets can do one of 3 things. It can go up, it can go down, or it can go sideways. So we want to focus on that. Whenever we look at a chart, we want to know, okay, first of all, the price action, right, which is the most important thing. Is the price going up? Is the price going down? Is the price going sideways? Because again, you see, many people will talk of many different things like oscillators, moving average, and so on. All these are actually derivative of the price action. So again, we want to focus primarily on the price action. Then we want to look at a time frame, because you see, we can look at the same chart. Let's say we look at the euro dollar, and you would say, oh, it's in an uptrend. And I would say, no, it's in a downtrend. And then we won't match our ideas looking at the chart, because maybe you are looking at a 4-hour chart and you're more short term, where I will look at a weekly chart more on the long term. So that's why we have to see, okay, which time frame are we using? Then again, within that time frame, we need to look at the bigger picture, right? So we need to understand the short-term price action within the larger trend, what is called sometimes as secular, which is the long term, and the tactical, which is the short term. So for example, here, you have a weekly chart of the euro dollar. And you can see that if we look at 2000, sorry, are you able to see my, let me just do a pointer. There we go. So if we do from 2017 and we go up to 2018, of course you can say it was an uptrend, which is very true. But if we look at the longer time frame, you can see that we are in a long-term downtrend. So that uptrend, although it lasted a year, but is a short-term uptrend within a very long-term downtrend. So again, you need to know what is your time frame. So to look at it, we want to start a chart with knowing, okay, what are our support and resistance, because this will define where are turning points, and especially if we can see any breakout from a trend. So for example, if we start here, we see that the 89 level, there were always sellers coming in. Whereas at the 51 level, you have many buyers coming in. So the price was in this range. Then we were able to break out from this range. And as we say in technical analysis, the longer a range, the stronger the breakout. So you see that sometimes you break out and then the price comes back and the resistance will change into a support level. Same here, you can see again that you have many resistance level around the 26 level, and again, support level around the 20 level. So that'll give you ideas. Then we want to see, will it break out? And we don't know at first, is it going to be, a breakout to the upside or a breakdown to the downside? And you can see here, for example, with the Tesla chart, a weekly chart again, that we started off having a resistance, then we broke out of that resistance, price came back to turn as support and found a new resistance and came back many times as a support. And again, many times you have the same resistance. So it is really the supply and demand that is acting here. And again, once we broke out of that resistance, that level became again a support. Of course, it's not magic, right? It's more art than science. So you will have from time to time some, I would say, a spillover, let's say a gap, it will go through it. So that is what we need to be careful of, but it doesn't mean that it's the end of that supply and demand. Support and resistance are not only horizontal. You can also having ascending and descending, which are mostly known as trend lines. You have a few people that use actually support and resistance through moving averages. Here is a weekly chart of 10 cents, and you can see again how the price hits the moving average a few times to find support and sometimes find resistance. So this is very important for us to see where are the resistance and where are the supports. In terms of moving average, most people on the short term would be using an 8 or 21-day moving average. 50 is very well known in equity markets for the medium term, And in FX, they usually use 55. Why 55? Because this is a Fibonacci number. In a couple of minutes, we're going to talk about Fibonacci. And you would see that the FX world is working very well with Fibonacci, actually. And then most people I know are using the 200 as the long-term moving average, which mostly define a bear market and a bull market. What we also want to look at is a relative strength. So what is relative strength? Again, you want to bet on, if you go to a horse race, you want to bet on the winning horse, right? But you don't really care how fast that horse is running. You just want it to run faster than the next horse. So how do you find that outperforming horse, so to say? So let's take a benchmark, let's say the S&P 500, and here we have a daily chart of S&P 500, and the blue line is our moving average, and the red line is, the 50 moving average, and the red line is our 200 moving average. So you see that in 2018, at the very early beginning of this year, we had this fall, and the price went down to the 200, came back up to 50, back again to 200, and touched 3 times the 200 before going back up. So let's bring in Adobe, which is one of the outperformer, right? So how do you see it's outperforming the market? Because in 2018, when we had that big drop in the S&P, actually the stock, Adobe, only went down to the 50 moving average and was able to stay above the 50 all the time. If we take another stock like MasterCard, same thing. In 2018, it came down, but only to the 50 moving average. So you see that MasterCard, Adobe are outperforming the S&P. So these are the stocks we want to find and look for and invest in. So the way you don't want to have those two charts next to each other on your screen all the time, right? So how do you make it easier for your eyes not to have those two charts, or one, your benchmark that doesn't move, and then going through so many charts for yourself? So one way is to divide your stock by your benchmark. So for example, here I'm dividing MasterCard by the S&P, and I have a nice uptrend line. The ratio itself, the number, is not important. What I want to focus on is actually the trends, right? Is it again uptrend, downtrend, or sideways? So uptrend, again, the stock is outperforming the benchmark. Downtrend, stock is underperforming the benchmark. That you want to avoid unless you want to go short. And if it's a sideways, I would say just avoid or invest into the benchmark itself, because then you have less risk. So the way I use relative strength actually is I put it this way. Again, this is still MasterCard divided by the S&P 500, and I have it at the bottom of my screen. And then I add the MasterCard itself to see the price action. So we see that it's a nicely in the uptrend, right? Making higher highs, higher lows, staying above the 50 moving average, and it is outperforming the benchmark. So this is a fantastic stock. Now you see here, what I also use is the RSI. So why do I use the RSI? The idea is with the RSI, I can find momentum, and I want to look for strong momentum. So I go through the RSI, which is the relative strength index, which is different from a relative strength. So you can see here we have the S&P 500, the 1 month chart. And you can see clearly here you have uptrends, a downtrend, another uptrend, downtrend, uptrend, small downtrend, and another uptrend. So the way we look at the RSI is that many people will say, oh, once it's overbought in here, you have to sell because it's going to go down. But actually, you can see here, the RSI stayed overbought for quite a while, and the S&P went up for quite a bit while the RSI was still overbought. So the way I look at the RSI is I actually draw a line at the 50 level, which is just in the middle, right? RSI, again, if you're above 70, it says overbought. Below 30, it's oversold. So I'm interested into the 50 level, just the middle. And you can see that when we were in uptrend, the RSI actually, although it went overboard a few times, it always stayed above the 50 level. When it went in a downtrend, RSI stayed below the 50. Again, an uptrend, RSI is above 50. Downtrend, RSI stays below the 50, or maybe a change here. So we see it's the start of a new uptrend. It went a little bit below the 50, but otherwise it was always nicely above 50. So that gives me an idea, okay, are we in uptrend or downtrend? Again, RSI above 50 and RSI below 50 gives me the bullish trend or bearish trend. So now I know we're looking at many things one after the other, but this, you will understand why we want to look at so many things, and this will come together in a few minutes. So Fibonacci, again, here's the explanation of the numbers, not too important because all the tools you have on any charting software will have it automatically. This is just information if you're interested, if you're like a mathematician in your head. So what we want to do with Fibonacci actually is we want to look at retracements and extensions. And we use those for support, resistance, and especially for targets. So you have, for example, before I explained about support and resistance and talking about a breakout or a breakdown. So we want to know, okay, once you break out or you break down, where is the price going? What would be the next level? What is the target? So for this, I use Fibonacci. So the way we do it, and how do we apply Fibonacci is, for example, here on the weekly chart of euro dollar, you had that downtrend, and then you had a sideways pattern. So during that sideways market, I take the high and the low. And once you use that tool and select high and low, the tool will automatically show you the 1.618 as well as the 2.618 and so on. And that would give you the next target, which means that when the price here broke out of the high and that sideways market, it came back to test again the breakout level and change resistance into support. And then we went up to hit that first target of Fibonacci. Same chart, but to look again in another way at Fibonacci is that once it broke out, you had that nice uptrend. Then you had a retracement. So I want to take again from the top so the high, sorry, to the low. And when I slide the tool of Fibonacci, it again gives me automatically the first, second, and third targets. You see again that once we broke out from those highs, it went into the first target. Those two were weekly charts. Now let's look again euro dollar, but this time on a daily chart. Because again, what's great about technical analysis, you can use exactly the same tools the same way on any chart, anything that has a price, and especially on any time frame. So for example, here you see again a downtrend and you have a retracement. So I take from the low to the high of that retracement. And once we broke the lows, you see I went to the first and to the second target done by Fibonacci. The price then came back up to the breakout level, again, turning a support into resistance, and went straight down to the second target. And then we moved again across first and second target. And now we broke second target. So there, I feel the euro dollar will go down to 112.70, which is the next Fibonacci target. Again, what you can do is some people say, okay, I don't like this very small retracement. I'm more into taking this low to this high, because many people are asking me, okay, how actually do you draw your Fibonacci? Which points do you take? So just to show you with the very same chart, instead of taking this low to this high, you would take the low here to this high, which is a bit this sideways pattern. And again, as we break down from that support level, I have my next target will be 1.1299. Last one on Fibonacci, this is a 60 minutes, so the 1 hour chart. And you can see again that with the downtrend and you have a retracement, I take the low to the high, and once we break down that support, it goes to the first level, the first target, and now my second target is at 113.65. So again, it depends. You see that you have different targets depending on which high and low you use on Fibonacci, and especially which time frame you use. So you just need to stick to the time frame you want. So we looked at many things, right? Supply and demand, so support, resistance, relative strength, Fibonacci. So why do we look at so many aspects? Is because if they are all pointing to the same direction, that gives you a better chance of success, which is also known as confluence. So we want to get that confluence. So if we move now to Hong Kong, for example, just this, and we have here the compositing the utilities sector, and I have here the utilities sectors in Hong Kong and compared to the benchmark itself, right? The Hang Seng Composite Index. So you see lately, since beginning of the year, it has outperformed the index, and the price itself is doing high highs and high lows, and the RSI is able to stay above 50. So then you can drill down into every single stock in the utility sector to find some outperforming stocks. Again, you would go there to look at the stocks and have it against the benchmark, which then will be not only the HSCI, but actually the utility sector, to find the outperforming stock into an outperforming sector from that benchmark. Now, if you look at the financials in Hong Kong, well, it's another story, because you can see that although the price went up, you were actually underperforming the sector, the benchmark, sorry. And now the price starts to decline, right? Making lower lows and lower highs. And relative to the benchmark, it is also underperforming. So financials in Hong Kong is not something we want to look at the moment. Same goes for consumer goods. You had a higher high in price, but the lower high in the RSI, which is known as a bearish divergence. You see now the price starting to break down in a downtrend, and also relative to the benchmark, you see consumer goods that had their support turn into resistance. And again, resistance was able to break, came back down, break again, change that resistance into support, and now broke down again. So it broke that uptrend plus that support and resistance, and now is also again underperforming the benchmark. So consumer goods, we don't want to look at them at the moment. Materials, same story. Nice uptrend, broke that uptrend, about a 2.5-year uptrend, broke it. You also had a higher high, a lower high, so bearish divergence. And again here, nice support on the ratio, and broke down, trying to test it, and probably going down again. So materials, also not interested. So why do I do that? Because that will save me a lot of time. I look at all these charts on a weekly basis, and I go through them. So now if I see financial, consumer goods, materials in Hong Kong are in a downtrend, so I'm not interested to look at it. So it saves me a lot of time into my weekly process to not look at those 50, 100 shares that are under financial, materials, and consumer goods. Telecom, this gets interesting because you see the price is still in the downtrend, but price made a lower low, RSI made a higher low. So we have a bullish divergence. So maybe something turning around there. If we look at the telecom versus the benchmark, we see that it was in a downtrend. And since 2018, it has been on par with the benchmark. And now we had one resistance, second resistance, third resistance, and we are breaking out of that resistance. So we could, it's probably too early to get in, but this could be nice to keep on your radar, because this could be the next outperforming sector in Hong Kong. So this is where I want to look at each and every stock within the telecom and see if there's anything interesting in there. Now, this for me is currently the most interesting, is conglomerates. So that sector in Hong Kong was in a clear downtrend relative to the benchmark. And for 2.5 years, it was in the downtrend, and just now it nicely broke out of that downtrend. So I want to look into it, and we see also here on the price action, it's making like a saucer, if you will, where it, again, we don't know, but it looks like it could be bottoming at the moment, and that maybe money is flowing out of financials, consumer goods, and into telecom and conglomerates. So then, as this is quite interesting, then I'll go through every single stock within the conglomerate sector. So let's look at number one, Hong Kong. Then we see again, it was in a downtrend, and just now it broke out. We see also from the RSI that it was always a resistance just above 50, and now we broke out of it. So if we were willing to go into it and trade, so we'll think, okay, what shall we do? So you want to buy, and let's say we buy at market where it is at the moment. And I have here, I draw my Fibonacci from the high to the low. And the high was at 92, and this gave me 99, my second target. We also have here a support and another support here just underneath, which is at 87.10. So the way to do it is I will buy at 88.70, which is current price. I will look for a stop at 87.10, which is support here. So that means if we are below 87.10, that means the trade is off for me, because the price is not able to rise further and will probably fall back again, i.e. I'm too early into the conglomerates. And my first target is this 92, which is this high on the chart. Now, if I look at it and do a quick calculation, 88.70, my entry price, minus my stop is 160. My target at 92 minus my entry, 88.70, gives me 330. If I divide 330 by 160, it gives me 2.06, which means that I'm risking 1 and my reward will be 2. So 1 to 2 is not too bad, but for some is not enough. So let's see further if we find any other trade. So here's the 87 Swire Pacific B. Now, I like this chart better for the reason that it has been in a sideways pattern or even a saucer bottoming pattern for quite a long time, right? It has been 2.5 years. So as I said at the beginning of this presentation, the longer it range, the stronger it trends. So we have a nice resistance here at 1430, and we just broke out of it. So it could be the start of a new uptrend. The way we look at it as well is the RSI was able to stay above 50, which is very positive. So again, from Fibonacci, I take the highs to the lows, and it gave me a target of 1574. So now I'll take 1442, which is the current price to buy. My stop is at 14. Why 14? If you look here, you have a support here, which came resistance, resistance, and again resistance. So for me, this is my second line of defense, let's say. First is obviously 1430, but this is quite narrow from the 1442. So I want to give it a bit of space. So I take the next support level, which again is 14, and my target is 1574. So again, same calculation, entry minus stop gives me 42 cents. Target minus entry, 132. So $1.32 divided by 42 cents is 314. So that gives me a risk reward of 1 to 3, even a bit more than 3. So this is quite interesting. So then how would I play it with my portfolio? So let's assume you have a portfolio of $50,000 and you have a risk per trade. So that is what you decide, right? Some people take 0.5% because they want to be conservative. Some want to be more aggressive. So they go to 3%, maybe 5%. And so that is your amount per trade that you are ready to lose. So in this case, 0.5% of the 50,000, that will give you 250. Then you have your risk per share. So the risk per share is actually here, is your 42 cents. So 250, which is the risk you're ready to take, divided by your entry minus stop loss, 40 cents, gives you 595 shares. So I will buy 595 shares at that price. And that is how I would trade that and how I find ideas. Thank you.
Right, great, Jay. So can we have a look at your face again while I have some questions for you? All right, thank you so much. Yeah, thank you so much for sharing about your perspective in terms of using price action together with the confluence factors, as well as a short introduction in terms of how to size your trade and to manage your risk. So before I go on deep into the analysis part itself, I was just wondering, from your background as a CMT, I suppose you probably will have learned all the different schools of thoughts in technical analysis and all the different indicators, methodology. So how do you arrive at a certain technical analysis methodology that you use regularly for yourself? And how would you think about other kind of indicators and methodology out there? Is it something like a personal preference kind of thing, or do you have some rationale in terms of deciding which ones to use?
No, I think you spot on with it's a personal preference. Again, it's just like the time frame we talked about earlier, is what are you comfortable with? So I read a specific book on RSI during my second year of technical analysis, and it was just, mind-blowing and eye-opener, and she said I'm almost only using RSI. So again, it's up to you. So personal preference, yes, because they all work. I know a lot of people, they use the MACD and it works very well for them. So if you love MACD, just go for it and don't look at RSI.
I see. And so how would you decide whether or measure whether a certain methodology is working out for you, or how do you decide whether it's not working out for you anymore and you need to look at something else? Is there some thought process that you have in terms of this perspective? Because I understand that many new traders especially, so when they first start to trade, they will try to look at this guru to see whether what kind of strategy he's using, and then they try to use it and they don't seem to make it work, and then they decide to switch to something else. So it ends up they keep on switching, but they have not really found a right process for them. So do you have any advice on that particular aspects in terms of how you go on to find out what works best for you? Is there some kind of learnings from that phase?
Absolutely. It's again, following guru is fine because you need to learn from somewhere. And for me, for example, I was following a renowned team of technical analysts in New York, and they were showing out this relative strength and how to find those outperforming ones and so on and so forth. And for me, that was very logical and made a lot of sense. And that's what for me is like, oh yeah, I want to apply this because I understand, I know how to do it, and it makes sense. So if you're following one of the guru, I think it's good to follow a few of the gurus, as you say, and see what is their style and how they do it. And then create, so to say, your own in terms of what you can take bits and pieces from many different people, probably from all the speakers, on this summit. I'm sure there's tons of information and great information. So they should basically watch every single video and take things that make sense to them and its logic and they apply. Because if you follow a guru ABC, but you don't quite understand what he or she is doing or why he or she is doing this way and so on, it works very well for him or her, but maybe not for you. So you need to find what you understand and works for you and is logical and that you are ready to do. For example, I said, I work mostly on weekends for that weekly process that I do. And for me, it's very logical, like where do I start, what I'm looking for, and where do I end? And again, you will have, just like as I showed earlier, all the Hong Kong sectors, many sectors are in a downtrend, so there's maybe not much to do. So you have to also realize that when there's nothing to do, there's nothing to do. You don't need to force a trade and force to find something to make money. It will come, right? So you need some patience as well.
I see. And so what you shared about the relative strength comparison between a sector against the main index, that's something pretty interesting. So I was just wondering, so you are using that mainly as a way to filter out on a big picture perspective, which are the sectors you want to focus on for a start, right? And before you dive in deeper to look at the potential individual stocks in a relatively strong sector compared to the broad index. So do you actually also try to use the individual stocks strength against the sector strength itself to find the best stock among all the stocks within that particular sector?
Exactly. So I do this for Hong Kong, Australia, and the US. And what is, for example, even easier with the US is they have the sectors, and within the sectors, you also have industries. So then you look at certain industries within the sector. And from it, then you have, so to say, even less stocks to look at. So that helps you, again, to gain a lot of time into finding the right stock. And then I would say the stock itself, you can do it against the sector or the industry. That will help out. But because then we diving into more shorter term, I would say. So I'm more looking on a absolute basis because I'm already on a relative basis. I'm already in an outperforming sector and outperforming industry. So then I really look at, okay, which stock is about to break out or which stock has a retracement and ready to continue its uptrend and so on and so forth. So on the stock level, I'm less itchy, let's say, about the relative strength because I already found the sector and the industry that is outperforming.
I see. So relative strength will be more for a big picture filtering of the sector and the stocks. And then you will look at the individual stocks' own personal criteria, specifically from a technical perspective in order to decide whether that is the right time to actually get into the trade or not, right?
That is correct. Yes.
I see. Great. So in order to help summit participants have a better understanding of the rationale of how you go about conducting your analysis and your trading, I think it would be really helpful if you could share with us a bit about your workflow, let's say on a week-to-week basis and on a day-to-day basis. How do you go about implementing your analysis, execution, or even review workflow in order to have a complete control and picture over how you actually trades and go about doing your everyday executions?
Okay, sure. So on a weekly basis, I look at, so mostly on the weekends when market is closed, so there's no emotion involved, it's quiet. So then I will look Australia, Hong Kong, and the US. And I will do, just as I showed, I go through consumer goods, I see nothing there, financial, nothing there, so I pass. When I find a good sector, I go into the industry, which is currently only possible within the US. And when I have that uptrend or turnaround sector, then I'll go through every single stock of that sector. So because I filtered out, the other sectors I don't want to look, so I have less charts to look at. But we're still talking about a few hundreds charts every week. And from there, I look, okay, which ones are, again, ready to break out or have a potential good setup, especially in terms of, I look at candlesticks a lot, and I will jot them down. And I'll see are they ready straight away or not. And on a daily basis, I will then just look at that list of specific stocks that I have that are either Hong Kong, Australia, US, and in various sectors and industries, and just look at those and wait for the proper setup. So proper setup, and again, that breakout that we want to see from a resistance level or bouncing from a support level or a candlestick, chart pattern, and so on.
I see. So on a day-to-day basis, like during trading days, you will be more of like sitting there and monitoring to see which ones finally reach a certain point where you think it's viable to get into the trade. And as well as how do you go about monitoring those open positions that you have? Is it the same process as well? On a daily basis, you look at them, or is it you have actually a predetermined exit that you key in into your trading systems and wait for it to get triggered?
Exactly. So I look at the market mostly when it's closed, because I get too emotional if I look at it when it's open. So I always wait for the closing price. And closing price, by the way, is the most important price, because that's where people get together and say, okay, we're okay to close here. And the how should I say, the way I trade is it's just as I've shown, where I have my stop, my entry, and a target, and then I would not touch and just wait for the price to go up or down and either hit my stop or hit my target. Because many times it can be you get close to your target and then it reverses and comes down. That's how the market is. It's a rough market out there, and many times you still see like you're halfway to your target and you see like there's a bearish candle and there's bearish news everywhere, and you're like, oh, I better get out. You get out, what happens? The stock flies up. So it's once you're in, just close your eyes.
So in a way, you choose to adopt a very disciplined approach towards getting out of your trades. As in, once you decide that's going to be, you will not alter it, even if, let's say, midway through you feel jittery about it because of some news that happened over the night. You just simply let the nature run its course, right, in terms of the exits that you have already planned for.
Exactly, because what is important is when you find those ideas, those trade ideas, like this one on 87 Hong Kong, and it gives you a risk to reward 1 to 3. That means you have, if it works, you have another 3 trades that you can just close your eyes, and if you lose those 3 trades, you still at break even. So you need to find those that really give you asymmetrical, rewards for your risk. So each time they work, it gives you more buffer, let's say, to be wrong, and that will help you to close your eyes. But I would say we go back to the time frame. I think if you start in trading, you need to understand your time frame. Not only that, oh, I want to be a day trader, or I want to be this or that, is how can you take it in that sense? Meaning, if you open a position and you leave that position open overnight, are you able to sleep? Or are you just thinking about the position? And do you need to, look at your mobile phone every 5 minutes to see where's the price, where are we, and so on? So if that's the case, then you cannot be like a swing trader or position trader. You need to be a day trader because you need to monitor it every day. Whereas if you look at the hour chart or even the 5-minute chart, is it too stressful for you to look at every single tick that is happening and so on? And then you cannot, your target is here, your stop is here, you see the price moving in between, and you need to act because you cannot let it go to, your target or to your stop. So that means you shouldn't be a day trader. You should just, buy and close your eyes and move away and take a walk or do something else during the day. So
Exactly.
I think it's a very, it's not just okay, what do you feel you want to be? It's like, what can you be? You know, so you need to test it, try and look at the 5 minute chart. Are you able to hold your position without touching it by looking at 5 minute chart, or take a position overnight? Are you able to sleep or not?
I see. So in a way, whether you are able to sleep overnight while having an open position also is determined by how much are you actually risking in each of those individual trades as well. So which leads us to talk about that risk management or the way that you actually size your trade earlier on. I remember you were saying something to the context of 0.5% risk per trade. Is that a standard percentage that you use for all your trades, or is there any chances that you might vary that percentage at any time along the way?
I try not to vary, because if let's say you take 0.5 and then you take the next trade and you have a high conviction of it and you say, oh, this one will really work, and so you move to 1% or even 2%, guess what, it will not work, and then you lose even more. So consistency is very, very important. So I would say keep it. If you decide 0.5, keep it 0.5. You want one, go for one, and so on. And I would really just keep it, because remember, as you earn money, your portfolio of, let's say, 50,000 will start to increase. So your 0.5% or 1% will also increase. So instead of 0.5 being $250, next time it's going to be 300, and so next time it's going to be 500. So it will also increase as well.
I see. So based on 0.5%, which means that even you have like 10 positions open at the same time, you are technically only risking up to 5% of your total capital base, right? Assuming, of course, there's no gap down or there's no black
Yeah.
swan event. So is that, would that make the kind of returns you make be pretty slow as well? Because your drawdown will be significantly lower as well during like losing streaks and stuff like that.
Exactly. So you are obviously earning less, if you will, but the drawdowns are very bearable. So you don't get emotional, or you don't start thinking, oh, what just happened? I lost so much, and so on and so forth. So it's a very easy way. Let's say if you start with a lower risk per trades, to continue doing your research and finding those trades and going into those trades and so on. And especially if we, let's say, start the next leg of a serious bull market, for example, in the US, then by 0.5, I can really go into many different trades at a time. So if every other day there's another tech company, or at the moment the healthcare is fantastic, so if I go into healthcare and every other day I have another setup coming up, then it gives me a lot of money, so to say, to apply, because I'm only risking 0.5% on each.
Would that typically means that you tend to have a lot of different open positions at the same time? And how would you go about reconciling the fact that you might not want to have too concentrated holdings in specific industry or specific market or even in specific sector? How do you go about managing that, or if you do in the first place?
Oh, yes. So on the portfolio basis, let's say, I would not go over 5% of risk into a specific sector.
I see. And were there any occasions where you have fully deployed your capital and your trades are all still open at the same time, yet you found new trade ideas? So how do you go about reconciling that? Should you take a new idea? Should you exit some of your existing position? Were there any occasions that you experienced that?
It has not happened yet. So that's why by sticking to a 0.5, you need really a lot of trades for that to happen. If that were to happen, I would balance what is my weakest open position compared to that new setup.
I see.
And then decide which one. And especially if, let's say, the new setup is maybe in a new sector or a new industry, whereas my weakest open position is in one where I already have 2 or 3 positions, and yes, I would exit and go into that new position that is in a new sector or new industry.
I see. So do you personally use any form of leverage in order, let's say, for example, you have let's say 5 open trades right now, and you're just risking 2.5%, which means you might still be open to risking more of your capital, but because you're risking so little for each amount, so you might have used up your capital base. Do you actually go on to leverage in order to take advantage of new opportunities?
Leverage is can be dangerous. So I would use minimal leverage if needed.
I see. So you will just like fully deploy your capital. If it's fully deployed, you will just let nature run its course, and you will just substitute accordingly if there's a much better idea compared to the current one, rather than using leverage to take advantage of the new ideas. I see.
Absolutely.
I see. Okay, great. So thanks so much for sharing your experience and how you actually approach trading from your own personal perspective. So before we end off today's sharing and interview, I was just wondering if you have any words of advice, maybe like three advice that you would like to share with any of the summit participants out there, if they are to trade on their own strategy as from a part-time retail trading perspective, right? Is there any 3 main things that you think that they should be very, very focused about and very adamant about pushing it through to ensure that they stand the highest chance of becoming a proficient and profitable trader in time to come?
I would say one is look at, for example, price action. Price action is the most important thing. So look at the patterns. Look at the patterns that before a breakout, before something went up, what happened, what were the candlesticks showing you before that? And you have to really train your eyes on that. Risk management, this is the most important thing. If you don't have capital to play, you cannot play. So you have to secure and hold that capital. So that's why I start slow. That's why I put that as an example to start with 0.5, right? And when you are confident and it works well, then of course, not only your capital will increase, and if you want, you can increase to the 1% or 2%, but start slow. But start with real money. Don't go into a simulation. Simulation is I would say, too easy. You need that emotional feeling of having your own money into the market, and stay focused, be persistent. It's not easy. It won't happen overnight. Again, you need those few trades. Again, risking 1, making 3, or making 5, and slowly you will increase your capital. Maybe, I don't know, some people go full leverage and they have one chance and they double their money. Fine, but on the long term, I'm not sure how this works.
Exactly. So
bit by bit.
Yeah, I suppose if those just try to one-time leverage and then they made money out of it, they'll probably lose the entire sum the next time around as well, because they will figure out and think that it might be such an easy thing to do. So anyway, thanks so much again, Jay, for participating in this online trading summit, which I believe that the summit participants will definitely get some good insights from your presentations. Meanwhile, I wish you all the best in whatever that you do, and hopefully we'll have a chance to chat and maybe for me to interview again to find out things, how things are from your side, and any new insights that you might have to share with the participants. All right?
With pleasure. Thank you so much for the invitation.
Thank you, Jay. See you. Take care.